On today's hot sheet, I'm discussing last week's FOMC meeting, Jerome Powell's comments specifically on housing, and what the heck has happened to housing inventory in the last week. Today is Monday, November 11th. Happy Veterans Day 2024. I am Byron Lazine, and the hot sheet starts now. Good morning. Welcome to a new week here on the hot sheet. If you're getting value from the hot sheet and what we're doing here at BAM each and every single week, subscribe to the YouTube channel. Make sure you leave us a review on Apple or Spotify if you listen to the hot sheet replay there. It helps us greatly. To better support what we're doing at BAM, jump into BAMX using code HOT. Everybody in BAMX now gets a platform with Zudelia, which helps you get more listings. BAMX, of course, gives you the most relevant data in the market to enhance your marketing content. BAMX in a box delivers done-for-you content every single Friday, and our hot sheet show notes directly from this show and all of the charts every Monday through Thursday fill up all of the conversations that you need to be having with your clients today. All right, let's jump in here. We've got to catch up from the end of the week last week. With the election being Tuesday, the FOMC ended up meeting on Wednesday and Thursday. It's typical throughout the year that they meet Tuesday, Wednesday, press conference Wednesday. We address it Thursday morning. Obviously, with the hot sheet being off now on Fridays, we're going to cover it now. For those of you that have access to the hot sheet show notes, you will know that just like every time, we break down every single part of Jerome Powell's talk, as well as the prepared statements into the hot sheet show notes so that you have access to that as it relates to housing. As expected, the FOMC and Jerome Powell made the decision to decrease the Fed target rate by a quarter point. The target rate is now 4.5 to 4.75. The expectation is that in December, we will see one more quarter point cut. Early CME Group odds say that is a 65.6% chance, with a 34% chance that there will be no cut in December. Obviously, a lot more data needs to come out, but the CME Group, as you get closer to these dates, which the next meeting is in 37 days from today. So we're going to get one. It feels a little quicker. Usually it's like 45 days. I think with the holidays, December, all of that, we're getting one a little earlier on the calendar than we're accustomed to. So it's only 37 days away, but there will still obviously be a whole bunch of data that is released between now and then. Shout out to the CME Group, by the way. They are actually hosting at my golf club right down the road here at Tiburon in Naples, the event here this week. So I'm seeing all their signs everywhere, CME Group. I'm like, hey, CME, hit me up. I'm always giving you the mentions on the hot sheet. So the benchmark now being reduced to 25 basis points, 4.5 to 4.75. It's the second consecutive rate cut. Again, it's as expected. This time we had a unanimous vote. So the decision was in full agreement from the 12 members. Remember, previous meeting, when they did the half a point, there was one dissent. It was 11-1. Now we have a 12-0 consensus here to go ahead and move forward with this second cut in this rate cutting cycle. Fed officials highlighted that supporting employment has become, which to me is a little bit of an interesting angle. They've been taking this angle here for some time. Hey, we need to support employment. Okay, well, what are we seeing down the line, with employment that has us worried? To me, it's been quite obvious because we've had some numbers, throughout the year. The job total numbers have continued to get revised down. Government has been the number one or number two source of hires throughout the entire year. Every single month, that is true. That is supposed to not be true as we move into 2025. We'll see what that DOGE committee, the Department of Government Efficiency, actually does there in terms of reducing headcount from the government level, and what kind of an economic boom might take shape here with the new administration. Wall Street, of course, believes that there will be an economic boom. The day after the election, as covered here, was a record day on Dow, one of the top 5 days ever recorded in the stock market. We now, over the weekend, saw Bitcoin go up over 82,000. That's an all-time high. So investors say, hey, we believe the economy is going to have a boom. There's numbers that are they're talking about as a 5, 6, 8% GDP growth in a year, which would be unprecedented growth. But there are investors that believe that's possible for America and more possible today with the new administration. As we're in a federal funds target rate cutting cycle, we can see that in cuts in the past. Look in the early 2000s. Look in 2008. Look, obviously, what happened in 2020. These cuts tend to go deeper than just what we've experienced so far. So the expectation is that over the next year, 2 years, there will be a more cuts coming. Again, of course, the cuts expected in December are coming in at a 64% chance, 65% chance, according to CME Group. So it's not a guarantee that we get one in December, but the expectations are that will happen. CNBC says that Fed officials have justified the easing mode for policy as they view supporting employment becoming at least as much of a priority as reducing inflation, at least as much. So this supporting employment is equal to getting down to the 2% mark of inflation. Of course, we have a dual mandate from Congress. The statement slightly downgraded the labor market, saying conditions have generally eased and the unemployment rate has moved up, but it remains low. The committee again said the economy has continued to expand at a solid pace. I still have questions about the expansion of the economy based on how much of that is wrapped into government spending. If we could get close to those numbers where it's like we're talking 5-6% economic growth, and the government is actually reducing spending, you're talking about a boom in that scenario. It's probably a dream scenario. Can the government actually pull something like that off? Totally remains to be seen because we haven't seen anything like that. All right, now let's go to housing and what Jerome Powell said about housing. We have in his opening statement one mention of housing. I'll read it to you, and then we'll get some reactions from the Q&A. We'll go to the videotape and we'll take a look at. We pulled out. I mean, he spoke for almost an hour. We pulled out the 3 questions that had a housing element to them, where Jerome Powell had to answer a question in relation to housing and rates. We pulled those 3 questions out. We're going to review them together. In Jerome Powell's opening statement, though, he did say, and this is straight out of the Hot Sheet show notes. You guys get access to this inside of PAMX, as well as all the timestamps. So you don't have to do the work digging through that entire press conference. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter. That could get revised down, by the way. About the same pace as the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. And yeah, the activity has been weak. We're trending right now towards the worst year on existing home sales, total sales for existing homes since 1995. Wall Street Journal obviously plastered that over on as a headline recently. And so activity has been weak. When you print all this money, Jerome Powell, the money that you convinced the last administration or the current administration, which will be the former administration, to go out there and and blow there at the beginning, say 22 or 21 and 22, whenever that was obviously not a good thing, and really amplified inflation to the degree that we had to work hard to get it back down. All right, we had a question from the Adam Schefter, as I call him, of the Fed. Adam Schefter is obviously a insider on the NFL. He gets all the data leaked to him from the owners and what have you. Well, Nick Timiraos from the Wall Street Journal is kind of that guy for the Fed. He asked a question. One of the first questions in the press conferences came just under the 10-minute mark. And we'll go to Nick T's question and Powell's response.
Chair Powell, Nick Timiraos from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
Yeah, what wasn't mentioned there? So he mentioned stronger growth. Okay, so the 10-year, remember, was flirting with 5% a year ago. So that was a good highlight by Nick T. The 10-year has come off of some of the high marks that we've seen here in the recent couple of weeks. Right now, coming in at 4.30. If we just look at the last month, we're off of that high mark of over 4.4, almost got to 4.5 again. We're still elevated from where we were a month ago when we were down at the 4.1 level. If we take a 3-month look, think about it. We got all the way down below 3.75. We're in the 3.6 range there for a little bit. And, coming out of July, that number, from August to October, we're really in a good place with the 10-year, certainly back now up to 4.3, which will keep rates a little bit elevated. But, there's no question a year ago, we were flirting with 5. I mean, look at this point here. Here and more so here, if we go all the way back to, just think about last November, October of last year into November, we had touched 8% on the 30-year fixed. And now today we're sitting below 7%. We got up over 7% there in the couple weeks, leading up to the election as that 10-year was being elevated, but we're not at the same place that we were last year. So, Nick T's, comment here about, these higher borrowing costs, if they were sustained, would weigh on economic activity. Right now, the Fed believes that this policy is restrictive. That's what he said in the opening statement. Nick T basically referenced back to that. And so now the Fed is starting to dial back that restriction. But even where they're at right now, the feeling out of the Fed is, hey, we're still at a restrictive policy. Are there growth risks presented in having these higher U.S. Treasury yields? Like, basically, how does the housing market, for an example, there's other growth risks that he's talking about, but let's just take the housing. Like, can housing actually unlock in spring of 2025 if this long-term rate, if the 30-year fixed mortgage, for example, is at an elevated state. Like, because the confidence is there, because there's pent up demand, because there's more people that want to buy a home. Does it actually happen if we don't have a lower rate environment in spring 2025? And Powell goes to, hey, there's a sense or a likelihood of stronger growth. And so that is maybe going to outweigh some, like if the growth is going to be strong, maybe even if rates are higher, some of these things can grow despite where rates are. I do believe we've seen enough evidence that, we've got to get rates closer to 6. I mean, we know there would be a total unlock at about 5%. I think that's a general consensus around the housing sector. Like, you get to 5%, you're really going to see, a boom housing market in the sense of fluidity and inventory and people moving and all of that a lot of that will get unlocked. But 6 is I guess a happy medium from where we're at, where you get to 6, you will see conditions strength. You will see conditions get more normalized. Okay. And so they're watching this. And one of the things that he didn't mention though here is what's holding back this, this long-term rate is the looming issue of the deficit, the government spending. That's got to get addressed, post January 20, post inauguration day. The government spending, the interest payments, that gets addressed. Our debt, and we're growing. If you kept government spending at the same level or a little bit lower, and then we're growing double, our debt becomes a lot more attractive. It's easier for us to obviously make those interest payments. So the economic boom and or reducing government debt has to happen quickly. The consensus from Wall Street is that it will. The confidence that Jerome Powell talked about appears to be there. The sense, he called it, of more likelihood of stronger growth. If this happens, it makes everything a little bit easier. Now, we had a question about 23 minutes, just over 23 minutes into the press conference, from Edward Lawrence, rather. Edward Lawrence is from Fox Business. This one is geared towards inflation. Let's give it a listen.
Edward. Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So yes, we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand,
right there, Bobby,
January reading.
The last 3 months of last year, the core PCE readings were very low. Remember, we had high rates. Then we came into January. Those rates were they were dropping very fast. I'll go to a chart here just to bring us back in time. If you could bring me back into full screen here real quick, Bobby. Thank you. If we go to last year's time, look at the 30-year. After we hit 8% in October, those PCE readings that he's talking about right now that were coming in almost unsustainably low, look at what it did to the 30-year as the 10-year was dropping last year in quarter 4. We got down to 6.6, which is lower than where we are today, at the middle of December. And so when we were coming into January, if you remember, it was always there was all these housing people running around the year of the fives, talking about 30 years, like as if this thing was just going to keep steamrolling and there wasn't going to be bumps. We here on the hot sheet took the other side where it's like there's going to be bumps, inflation's going to be sticky. Powell is saying it is. Analysts who are looking at this are saying that it is, and it's going to have an impact, and you're not going to see 5% rates. That obviously, here we are on November 11th. That couldn't have been more true than ever. Like, we're not going to see 5% rates in 2024, and we didn't get anywhere close to that. We didn't even get anywhere close to having an average of Walmart pricing at 5.99, the 5 handle, making people feel better. So Powell there, I think what he's saying is absolutely true. And let's go back to the rest of the answer.
Certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services.
Here he goes.
So let's talk about
jam
housing
on
services.
housing.
Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is, I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be one or two really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
All right. There you go on Powell's comments as it relates to the PCE. Again, we'd be at 2% to Lawrence from Fox Business's question there. We'd be at 2%. We're, depending on what numbers you looked at, I threw a couple of different numbers there. But housing is holding it back. My, argument is, obviously he mentioned it right there. He said, hey, market rents right now has very low inflation. So what's happening right now, what you're in the middle of, Jerome, is the reality. You've got low inflation on market rents. But what's creating a higher number on the housing is leases that were signed a year ago, taking several years to catch up to where market leases are. And so again, the Fed operates under very lagging data, which can cause them to not act fast enough. They didn't act fast enough as inflation was going up. And now as inflation is going down, and we potentially might be walking into a 2025 boom economy, is he reacting fast enough? Now, that is certainly the debate. There's still going to be questions about whether or not there is, recession indicators and all of that. You haven't heard that much the last week because the markets are such in favor of the election results. But you still have some of those issues popping up. If you don't get these rates down, you'll hear about it more in 25 because of commercial loans coming due and regional banks holding all of that. We've been through that and we know all about that. Let's go to Kelly O'Grady. Last question here that relates to housing. CBS News. She asked a question just under the 40-minute mark here of Powell.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And
pause it right there real quick.
The world went through a global inflation.
So, I mean, this was one of the things we talked about last week where, and you can go full screen just for a second if you'd like, Bobby, and we'll go back. This is one of the things we talked about last week, the exit polls and really ultimately the election results. I mean, what she's talking about here, Kelly O'Grady from CBS News, is right on the money. Americans are not feeling a strong economy. Powell gets up there every single 45 days. Every time he doesn't only talk 45 days. It's not like he's Lawrence Yun from NAR who only talks once a month. He'll actually give some talks here, between meetings and all of that. But he always refers to this, strong economy. But that hasn't actually impacted a lot of Americans. That's why a lot of Americans who disapproved of the current administration, voted for a change in economic policy, voted for a lower inflation environment, and the economy is not performing for a lot of people. Wall Street having their best day and investors being giddy about the growth and all of that, might turn out to be true, or it just might mean that the 5% or so of Americans that are, playing the Wall Street game are going to benefit. Okay. Like, the cost of milk and bread and normal groceries and, electricity and insurance and these things to most Americans are much more important than what's going on with the stock market or GDP growth or hiring numbers or the fact that the government is going to hire more people next month than the private sector, right? Those things, those are two different worlds and two different ways to look at the economy. We'll go back to Powell's answer here. He said, the economy is performing well in their metrics, but we also know people are still feeling the effect of high prices, which, by the way, those high prices never come down. Okay. The thing about inflation is those high prices stick. It's about not getting them to go up more from here. It's not like bread's going to get cut in half, in February of 25. The prices are where they are. That's part of the issue with printing as much money as we did. And now we're kind of stuck with those prices. It's about getting them to only go up 2% a year from here. Go ahead.
Inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is takes some years of real wage gains for people to feel better. And that's what we're trying to create. And I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up.
Thank you, Jerome, for respecting the feelings. And you can move on from that. We've got a lot to cover here on inventory, but Jerome Powell respecting the feelings. His feelings seem to be a little bit, questioned there, as he was asked. Also, we won't play it. I'm sure you've seen the clip. Was asked if he was feeling like he was going to get fired by the new administration or if he had any plans to resign. He said no. He has a position, through 2026. He said the government cannot fire him, meaning Trump cannot come in and fire him. Remember, Trump also appointed him. There was just some belief that, Trump's going to come in and clean house. Trump's been critical of Powell. Even when he appointed Powell, he had been critical of Powell, and he's been critical when he was not the president of Powell. But doesn't appear that Powell is going anywhere. And so, we haven't heard any responses from President-elect Trump on what is going to happen there. But Powell said he went Jordan Belfort and said, "I'm not going anywhere," essentially, in the press conference. So we'll see what happens there. But the expectation is that Jerome Powell will remain chairman of the Fed. Inventory, very interesting. We said we wanted to look at what happens during election week. Is this going to take the shape of maybe a holiday? Is there going to be some type of pullback on inflation? Remember, the downside, the seasonal downslide of inventory hasn't really kicked in. It's happened later this year. If you look at 17, 18, and 19, it happened much earlier. So this week in particular was very interesting. What would happen? Well, we saw that downside impact on inventory from 735,000 now down to 721,000 on active inventory, according to Altos Research. Still 27% more than last year. You can see now that the move downward here, and it typically just gets more drastic as we move through November and December. That downward movement happened, August, September time frame. If you go back to 17, 18, 19, we really continued to see an increase from August, September into October, and now the last couple of weeks starting to see a downward movement on inventory. But this was the biggest number we've seen in quite some time, 14,000. How much of that had to do with the election? Okay. Well, if we take a look at new listings, I would say that this number was impacted by the election, but this is just a guess. We had 48,000. We typically do see sharp declines. You go back the last 2 years, you get into November, December holiday, you see sharp declines. You'll see a little bit of a bump up there after, what might be a Thanksgiving drop, a little bit of a bump up, and then another sharp decline as you get into the end of December. But this week, same week last year, well below 23 and 22 levels. 2024 on pace again to be the second lowest level ever recorded for new listings. Okay. 2023 being the lowest, of course. This past week, 48,000, basically 49,000 on new listings, well below last year's 55,000 for the same week, and almost 53,000 for 2022. So it'll be interesting to see what happens next week on new listings. Do we get a bump up after the election? Or are people saying, okay, election's over. They take a look at the calendar and like, wow, in 2.5 weeks, we're going to be sitting down at the Thanksgiving table. Like, it's an all stop basically until January for some people who like want to do the holidays at home and whatever the case, they don't want to be in the middle of a move, showings, etc. You're going to have a seasonal pullback that we always have. How sharp is it going to be? Next week's going to be a huge indicator on that. Even with this downward movement on active inventory and new listings in particular, we're not seeing that on prices. In fact, the price cut percentages for the last week have improved from 39-40%, which is where the trend line has been here for the better part of 3 months. We're now down to 38.8%. First time I'm able to say, hey, we're down below 39%. Last year we were at 39 and the year before at 43. So trending better than the last 2 years on price cuts. So prices are holding firm for the most part. It's not like sellers are in trouble. Okay. It's not like we're entering some type of issue here in the housing market for home owners. I mean, I think that, Logan Motoshami from Housing Wire does a good job trying to educate people on that. Couldn't be more apparent in one of his most recent tweets. Mortgage delinquencies and foreclosures actually below pre-pandemic levels. Mortgage disclosures, Bill McBride from Calculated Risk said in his tweet, mortgage delinquencies decreased slightly in Q3 of 2024. And that decrease now that slight decrease is still under pre-pandemic levels. It's way under 02, 03, 04, 05, 06 levels before the crash, obviously below basically everything on the chart here the last 22 years. So delinquencies here trending very low. Homeowners are not in trouble, so they don't have, this issue, any issues looming in terms of being able to afford the home. Remember, a lot of people are locked in a very comfortable situation, even if they'd like to move. In terms of payments, they're good. Okay, and so you're not going to see, home prices come down dramatically, and especially with where we're at on inventory, as we just referenced. Mortgage purchase applications, while we've seen an improvement over the last several weeks, almost 2 months of improvements when you look year over year, it'll be interesting to see, what happens when we get that inflation or that election week data as well. Pending sales, according to Altos, we're at 11.5% more single family homes in contract than at this point last year. So showing some signs of improvement there, according to Altos. And there you go on where we're at on inflation inventory. Sorry, so much inflation talk today. Inventory, as expected, we saw a pullback on election week. It'll be interesting to see if it really intensifies. These last couple of months could really hurt the inventory gains that we've had, or they could, these next couple of months rather, or they could, if we can stand ground here a little bit as it relates to inventory, could really help what the spring 2025 market looks like. And so there you go. 30-year, or the 10-year rather, still at 4.306. The 30-year came in to end the week at 6.92. Lowest read in a few weeks there. The weekly came in at 6.79, up from the prior at 6.72. We'll look for more improvements on the 30-year this week. The stock markets are open. I saw Jason said, hey, didn't know the Hashi was going to be open today. We are on, even though it's Veterans Day, because the stock market is on. Try to match those best we can. 52-week high today on the Dow. So Dow again ripping and roaring. We have a investor community that is very bullish on last week's results. 52-week high set already today here on this Monday coming into the week. Happy Veterans Day for everyone out there. If you're a veteran, thank you so much for your service and the opportunity you give all of us to be Americans and do what we do. So thank you. Thank a veteran today if you get a chance. Obviously support your local veterans in any capacity that you possibly can. Use code HOT right now to get into BAMX. We've got all of our data being uploaded there every single day, so you can be fast acting on your content, done for you content every single Friday, as well as a Zoodealio platform, which helps you get more listings. So many of you guys are already utilizing that to generate offers and get more listings. That's your hot sheet here for the day. Hope everybody has a great day. We'll see you back here tomorrow live, 9:30 on the East, 6:30 on the West. You know the deal in between. And until then, toodaloo.